listening to Capital Topics, episode number 56. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, we'll review the basics of registered education saving plans, RESPs, and withdrawal strategies. And for our next topic, we'll discuss investors' home market bias. Enjoy! Good morning, James. How are you today?
I'm very good after a great summer. Weather wasn't all that great, but good vacations.
Yes. Since it's back to school season, we thought it would be a good idea to give you a brief overview of how registered education savings plans, RESP, works and what are the best strategies to tap into your RESP savings in the most tax-efficient way.
Yes, François. Today we're going to tackle the situation where after many years of diligently saving for your child's post-secondary education, you're now at the phase where your child needs to start withdrawing funds. So from our experience with clients, the withdrawal rules are really complicated. And that's why we decided to cover this topic today. And so we're going to explain how RESP withdrawals work and how to get the most out of those accumulated savings.
Correct. And not knowing how withdrawals work adds to the stress of seeing your kids start a new phase in their lives. So before we cover the withdrawal rules and strategies, let's review briefly how a RESP works. The RESP is a tax advantage savings account for a child's post-secondary education. We normally recommend opening an RESP as soon as possible after a child is born. You must remember to apply for a social insurance number, as this is a requirement to make contributions.
So some parents can decide to open it later, but we don't recommend that because you really want the magic of compound interest working as fast as possible on your contributions and just as importantly, on the generous grants that the governments give.
Totally.
So parents with young children, we know, have many competing priorities for their after-tax savings. Because the contributions are not tax deductible, it's best to start early and not be caught up with a large contribution catch-up. And we see a lot of people getting caught up with that. So the more kids you have, the bigger the challenge. I would like to remind our listeners, we covered in podcast number 23, the strategy of grandparents gifting money to their children, who in turn make the contributions for the grandchildren. And so that's a big help to them, and it's very tax efficient for the grandparents as well.
Yeah, totally. There are two main benefits to contributing to an RESP. The first is the tax-deferred growth, and the second, which you just highlighted, James, is that you will receive government grants on your contribution. At the federal level, you will receive the Canada Education Savings Grant, CESG. The CESG is a 20% grant on your contribution, up to a maximum contribution of $2,500 each year. This means you're getting $500 in free money on your contribution from the federal government.
Everybody loves free money. Other provinces also offer grants, I might add, but specifically here in Quebec, you get an additional 10%. So that's a total of 30% on your contribution. So assuming you make the maximum annual contribution of $2,500, you're going to receive $500 grant from the federal government, and then for Quebec residents, $250 from the Quebec government. These grants are deposited directly to the RESP. You can think of these grants as an immediate 20 to 30% return on your contribution. So again, there are other types of grants for low-income families, but that's way too technical for us to get into today.
There is a lifetime contribution limit, we should mention, of $50,000 per beneficiary, and a lifetime grant limit of $7,200 at the federal level, and here in Quebec of $3,600 from the Quebec government. These grants are available until the end of the calendar year when the beneficiary turns 17. However, since the CESG was designed to encourage long-term saving for post-secondary education. Don't wait until the child is 16 or 17 to open and make RESP contribution, as you may not meet the requirements to receive the CESG.
Again, François, that's very well said. It's important to mention, though, that if you can't contribute the full $2,500 in a given year to get the full government grants, the unused grant room is carried forward and can be used in future years. However, a word of caution, as there is a 1 year only maximum of $1,000 of grant from the federal government and $500 from the Quebec government. So the maximum grant eligible contribution for a given year with that limit is $5,000. So you can get a catch-up year. If you miss 1 year, you can do that.
Right. So now that we've covered the basics of RESP on the contribution side, let's look at how to withdraw the funds in the most tax-efficient way when the child goes to post-secondary education.
Okay, so François, our listeners need to know that withdrawing funds from an RESP tax efficiently involves a fair bit of careful planning. You need to make sure you understand the RESP maximum withdrawal rules, and you need to understand the tax situation of the beneficiary over the number of years you plan to withdraw funds for them. In the end, you want to avoid the situation where the beneficiary is going to have to pay tax at a much higher level on the taxable portion of the accumulated funds. You also want to make sure to optimize the withdrawal of grants for each beneficiary in the plan before they complete their studies. Otherwise, you may have to pay back the government grants.
Totally. First off, you need to understand that the amount accumulated in the RESP for each beneficiary belongs to 3 different buckets. The first bucket is your contribution, so that's the money you've put into the plan. The second bucket is the grants, whether federal and in some cases, as we mentioned, provincial grants. The last bucket and third is called the accumulated income. This bucket is the tax-deferred growth on the contribution in grants, which is composed of capital gains, dividends, and interests.
Okay, since these buckets are taxed differently, François, what we do for our clients is build a spreadsheet for each beneficiary to track how much money they have accumulated in each bucket, and this allows us to develop a tax-optimized withdrawal strategy.
Yeah. Now, to start withdrawing the funds from an RESP, the child must present a proof of enrollment in a qualifying full or part-time educational program in a university, college, or other designated educational institution.
Exactly right. However, before you start withdrawing funds, you need to have a discussion with the beneficiary to figure out how many years he or she intends to pursue their studies and estimate the total annual cost to complete their degree. You will also want to discuss the estimated income your child will be earning each year through work and internship programs.
Right. That's a good point, James. When you take out money from the RESP, there are 2 types of withdrawals. There is the post-secondary education withdrawal, PSC, which is essentially a withdrawal of your contribution. That's not taxable. And there are educational assistance payment, EAPs, which are composed of the grants, the capital gains, the dividends, and interest that have accrued over the years that are taxable in the hands of the beneficiary, that's the student. The T4 slips will be sent by the financial institution directly to the student for the EAP withdrawals.
That's very important technical information, François. So since these educational assistance payments, or EAP, the acronym, are taxed as income to the student in the year of withdrawal, it'll be important to know before withdrawing how much taxable income the student expects to earn. So ideally, you want to stay below the limit at where tax starts, which can be, depending on province, anywhere between $15,000 and $20,000 of taxable income. So in the early years, generally the beneficiary income will likely be low. Therefore, it makes sense to prioritize EAP withdrawals. However, as time passes, the student's income may increase because of higher paying summer jobs and internship programs, therefore increasing the likelihood that taxes will be payable on EAP withdrawals. At any point in time, you could consider a mix of PSC, or contribution withdrawals that aren't taxable, and EAP withdrawals.
Mm-hmm. Yeah, and once enrolled in post-secondary education, there are no limitations on the withdrawal amounts of PSC. However, there are limits on the EAP withdrawals during the first 13 weeks. The limit for full-time student is now $8,000. It was raised in the last federal budget from $5,000. And for part-time student, the limit was raised to $4,000 from $2,500.
The increases in these limits are very helpful, François, for planning purposes. But our listeners should know that after the first 13 weeks, there are no restrictions on how much you can withdraw from EAP. So you want to make sure your withdrawal plan depletes all your EAP before the beneficiary student finishes his or her studies. However, keep these annual withdrawals below the EAP threshold limit, which is $26,860 for 2023. Otherwise, you may need to show receipts and proof of expenses.
Yeah, you want to prioritize EAP withdrawals first, because if the child quits schools or there are still grants and accumulated income in the account 6 months after he finishes school, you may lose out on some benefits of the RESP. On the other hand, withdrawing contributions is not an issue. As I said before, that money belongs to you, the subscriber.
I would add, François, if the child quits or finishes school and there are still grants and accumulated earnings in the account, it can get complicated, but there's still a few options. First one, since you can keep an RESP open for 35 years, you can wait in the hope that the beneficiary may return to school later. Alternatively, if you are certain that the beneficiary will not be returning to school, you can transfer the grants and accumulated earnings to a brother or sister that is under the age of 21. Again, the maximum CESG grant of $7,200 per child nonetheless continues to apply. Therefore, the transfer of grants can't bring the siblings' total withdrawal of grants above that number. If there are any excess grants, they will need to be returned to the government.
Yeah. If there are no siblings, the grants must be returned to the government, as you mentioned, James. For the accumulated income portion, if the RESP has been open for at least 10 years, there are a couple of options. You can withdraw what is called an accumulated income payment, AIP.
Yes, but you will still want to avoid withdrawing outright the AIP, since these payments are taxable to you, the subscriber, at your marginal tax rate plus an additional 20% penalty tax.
Indeed, a better option if you have RRSP contribution room is you can transfer up to a lifetime maximum of $50,000 to your RRSP or a spousal RRSP and claim a deduction. While this accumulated income payment AIP is reported as taxable, it's fully offset by your RRSP deduction. If you don't have the RRSP room, you could delay withdrawing the funds until you have the room. Remember, you have 35 years before you need to close out the account. So you could also transfer the AIP to a registered disability savings plan if you have a disabled child.
Again, there are a lot of rules when it comes to RESPs, and it can get quite complicated. For any special situation, it's really best to discuss this with your advisor.
I agree, James. I think we covered the basics here, but I have two small things to add. First, when you get close to the time you will need to withdraw funds from the RESP, think of reducing the risk level on your investment to protect the funds. Second, all the funds withdrawn from the RESP don't have to be spent on school-related expenses if not needed. By that time, the beneficiaries will have become young adults and the excess funds could be put to work in their TFSAs or now FHSAs for retirement or the purchase of a home. Okay, for our second topic today, we'll discuss portfolio home market bias. As our regular listeners know, we are now in a new higher interest rate world. This new investing landscape is top of mind for all investors. In our podcast number 53, we tackled the topic of the 60% stocks and 40% bond portfolio as the starting point for setting your long-term asset allocation. So in today's main topic, we will drill down into the stock component of your portfolio, specifically how much global exposure you should have. So James, what are your thoughts on this topic?
Well, first of all, François, the decision really here is about investing globally as a first step. So we're focusing in on the equity allocation, The thoughts we're sharing today is really based on your strategic long-term allocation. It's not a tactical conversation, whether you're
Correct.
Canadian or US or international or emerging markets or relatively cheaper one from the other. So the standard allocation approach for global stocks is to invest proportionately according to market capitalization, which is the weight of the aggregate value of the stocks in each country. So this method really assumes that the markets are efficient and that asset prices reflect all available information and expectations of investors.
In practice, most investors around the developed world exhibit a strong home bias and overweight domestic equities relative to their global market cap weight. Recent numbers indicate that Canada represents only 3.4% of the global market cap. How do Canadians invest, James?
Well, again, Vanguard published a paper this summer on Canadian home market bias, and it was titled A Case for Global Diversification. And again, they're quoting International Monetary Fund data. So when you say 3.4%, that's where that comes from. And in the paper, it states that Canadian investors allocated 52.2% of their total equity allocation to Canadian stocks, which is really a massive overweight of 15 times the actual weight of 3.4%.
Yeah, despite the benefits of diversifying a portfolio globally, home bias has been strong among Canadian investors. Is that true for outside Canada, James?
Absolutely, François. Vanguard's paper has a nice chart that shows how home market bias is a globally observed phenomenon. Americans have a 79.4% home market bias versus a global weight of 65.5%, whereas UK investors have a much lower 26.3% home market bias, but that's versus a global weight of 4.2%. In developed Europe, it is a 53.6% versus a global weight of 18.2%. And again, this plays out across the other developed countries. So home market bias is really a global phenomenon.
Yeah, that's what I can see based on the chart. We can see that that most investors, in most countries, significantly overweight their domestic allocation to stocks compared to their country's market capitalization weight in a globally diversified equity index. While the market cap weight is a valuable starting point, I believe that several other critical factors should be considered when deciding your exposure to international equities. I believe that investors should carefully weigh the trade-offs, such as the volatility reduction, expected returns, implementation costs, tax consideration, and their own goals and ability to take on risks.
One way to evaluate the expected diversification benefits, François, of investing in international equities is to analyze the impact on portfolio volatility as we incrementally increase the allocation of international equities to the component of domestic equities. Vanguard has also produced a U.S. paper on the topic of home bias in 2021, and it was titled Global Equity Investing, the Benefits of Diversification and Sizing Your Allocation. And this research was based on market data ending September 30th, 2020. So for our listeners, this paper was written for American-based investors. And I'm going to quote from the paper. They state, in each market we examined, our analysis indicated that volatility was reduced most with an allocation to international equities of between 35 to 55%. While this observation may help investors determine the appropriate mix of domestic and international equities, volatility reduction is not the only factor to consider. Now, the Vanguard Canadian paper from July 2023 shows that the reduction in portfolio volatility for a Canadian investor declines as the allocation to international equity increases up to 70% and then begins to taper off gradually. This paper concludes, looking at the data, the optimal asset allocation for Canadian investors is a 30% allocation to Canadian equities and a 70% allocation to international equities because it has been shown to minimize the long-term volatility in their portfolio.
Yeah, our equity model portfolio devotes 20% to Canada, 50% to the US market, and 30% to international markets, which includes emerging market. If we remove our home bias of 20% to Canada, The remaining 80% of our equity portfolio is invested to reflect roughly the global market cap weight. So the 20% is really a home bias to Canada, since it was only 3.4% weight of the global market cap.
But we're a little bit lower in Canadian equity than what the Vanguard paper suggests, and that's been like that for a very, very long time.
Yep.
Again, we'll talk about that a little bit more shortly about the Canadian market. So again, I would add that the Canadian market has historically been more volatile than the global market without a proportionate increase in return. So that's really a bad deal for investors, and the obvious reason why you would want to add a substantial quantity of global stocks to your portfolio mix.
Yeah, modern portfolio theory dictates that the broadest possible diversification will be the most efficient for reducing risk. Therefore, in theory, your portfolio would replicate the geographic weighting of the global stock market.
So, on a positive note, François, Vanguard's research paper shows Canadian and other developed country investors may have realized the benefit of international diversification, as shown by the declining preference for domestic equities from 2012 to 22.
Yeah. Vanguard in their paper also highlights that the global pension assets over the last 2 decades reveal a notable decrease in the degree of home bias in equities. Specifically, the average weight of domestic equities has declined from 67.1% in 2002 to 37.7% in 2022 across Australia, Canada, Japan, the Netherlands, Switzerland, and the UK. In the last decade, the data shows that the United States has had the largest allocation to domestic equities, whereas Canada, Japan, and Switzerland have had the lowest allocation.
So look no further than Canada's big pension funds, François, as a guide, So again, these are among the most sophisticated pension investors on the planet. And how do they allocate their assets globally? So let's start with the biggest one of all, the Canada Pension Plan Investment Board and CPP Investments, which manages the $570 billion Canada Pension Plan Fund, doesn't disclose the geographical distribution of its $135 billion public equity portfolio. However, as of March 31st, only 14% of its total net assets were invested in Canada. And that's phenomenal. I don't think many Canadians are aware of this, that 86% of that big pot of cash is invested outside of Canada.
Right.
The Caisse de dépôt, on the other hand, the second largest manager of the Quebec pension plan, among other funds, has 21% of its public market equities portion of its $402 billion in net assets invested in Canada as at the end of 2022. So again, we're in good position with our 20%, and of course Vanguard's suggestion of 30%.
Right. There are several reasons why an investor might prefer to buy domestic stocks, but it usually comes down to familiarity. The companies that make up your local stock market you hear about in the news frequently on a daily basis. Home bias is nevertheless a serious impediment to portfolio diversification, which is the key to reducing risk, as we mentioned before. This is very much the case in Canada, where a handful of companies, just 3 sectors, dominate the equity market.
Well, yeah, Vanguard, François, does a good job of getting specific about that. And they have a chart that shows the top 10 holdings in Canada represent nearly 37% of the Canadian stock market index. By contrast, the top 10 holdings make up 16% of the global stock market. When it comes to sector concentration, Canada is heavily overweighted in financial services, energy, materials, relative to global market weights, and underweighted in information technology, healthcare, and consumer discretionary stocks.
Yeah, and those overweight and underweights are fairly substantial, James.
Yes.
And Morningstar also published a report recently titled "The Canadian Equity Market Isn't as Canadian as It Once Was." According to Morningstar Index's annual study, only 48% of the revenues from the Canadian equity market are actually sourced domestically.
Well, again, that's an interesting way of looking at the question. So some people believe by buying Canadian equities, all these large banks, all these other players have global operations. So we're actually globally invested. But we don't really agree with that thesis. So according to Morningstar, Canadian companies, like many other developed equity markets, have globalized their revenue sources. Canada is similar to the US, Japan, Australia, and most of Western Europe in having become less domestic. So despite the pandemic and geopolitics, François, globalization doesn't seem to be reversing the course.
Yeah, Morningstar adds, and I quote, "In emerging market, China foremost among them, tend to be more domestic in their revenue sources. Two outliers among emerging markets are South Korea and Taiwan, which source most of their revenues internationally. These are, as many know, tech-heavy markets. South Korea's international revenues are largely driven by Samsung Electronics, a global leader in smartphones, semiconductors, TVs, and more. The Morningstar Taiwan Index is dominated by Taiwan Semiconductors, the world's largest contract chip manufacturer."
So, François, let's pause for a minute and sort of think about what this all means. And in my view, with increasingly globalized revenue sources, especially from all these developed markets, that integration really can help explain the parallel rising of correlations among developed markets.
Yeah, but on the other hand, James, can multinational corporations provide enough global diversification as an alternative to just buying global equities?
Well, again, that's the common question about exposure to stocks outside an investor's home market. The thinking goes that because many large domestic firms generate a significant portion of their revenue from foreign operations, the diversification benefits of global investing are already reflected in their prices and performance. But we don't accept this thinking, particularly for Canadian investors. As we mentioned earlier, our stock market is considered a three-sector bet with high levels of concentration.
Yeah, I agree, James, for several reasons here. First, simply focusing on domestic company means an investor has no stake in leading global companies that are domiciled outside their home market. Second, the history of capital markets tend to demonstrate that exposures to foreign currencies help reduce portfolio volatility. And finally, as you mentioned, again, James, a portfolio composed only of domestic companies will likely have less well-diversified sector exposure than a globally diversified stock portfolio.
So you brought up a really good point about currency exposure. So again, a lot of investors worry about that when they're investing outside their domestic market. So investments in foreign markets are exposed to fluctuations in foreign exchange rates, but currency really has no intrinsic value. There's no yield, no coupon, no earnings growth. Therefore, long-term currency exposure affects only return volatility. So when we're building portfolios, as you know, the currency hedge decision is based on a number of factors, including currency contribution to portfolio volatility, currency correlation with the underlying asset, and most importantly, investor risk tolerance.
Yeah, currency volatility can be a major driver of risk, especially for fixed income return. That's why we favor in our fixed income currency hedged globally diversified funds or ETFs. On the other hand, for international equities, currency volatility can have diversification benefits, especially over the long term.
Okay, so François, I'm going to wrap this topic up by concluding that Canadian investors should consider allocating a significant part of their portfolios to international equities as a strategic decision for the long term. In determining how much to allocate between domestic, U.S., and international equities, a helpful starting point for investors is really the global market cap weight. In practice, we suggest investors consider an allocation below this starting point based on their sensitivity to several considerations, including volatility reduction, implementation costs, favorable tax considerations, currency effects, regulation, and really their own preferences.
Yeah. Okay, so thank you, James. I think we covered the topic. I hope our listeners found it interesting. So thank you for sharing your thought and expertise today, James.
My pleasure, François.
So that's it for episode number 56 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on October 26th. See you soon.